in the commentary you say difficult trading environments, and that's likely to continue in the short term. Tell me, where is the pressure coming from Spar at the moment?
Well, I think it starts with the consumer still being under pressure. So that situation, I think we're all up to date on. Access to credit and fuel and utility, all the various things that we know about. So that's there. Obviously, for us, we are also pressured by the fact that food inflation, which is fantastic for the consumer, has been very low, and at the same time we're also faced with wage costs and utility costs and fuel costs and all those sort of things, which unfortunately are not playing along. So one gets caught in the middle of that. As well, it is a very competitive retail environment, so everybody's scrapping for market share and for growth. So all of those things together make a cauldron that is not easy for trading. Having said that, we are not unhappy with what we've managed to produce.
What that scenario does, Wayne, is that it places extreme focus on squeezing the business harder from here on out. So let's look at that, because looking at operating costs in particular, those are up overall 16.8%. So what strides are you making in enhancing operational efficiency for one?
We're actually making, despite what that shows, making some good progress. I think one's got to understand that during the course of this year, we're primarily a wholesaler. We are a wholesaler. We have taken on some retail stores. We now own, during this period, 9 Spar and Super Spar stores and some top stores. So what you are seeing is the cost of running those stores in this year's expenses when you look at them in isolation, where there was nothing in the base. So that's one aspect. And the second one is that we also have got into wholesaling building materials. We never did that in the past, so opened a new distribution center. And so we have some costs of running those businesses, and there was nothing in the base. So if one was to try and look at our costs, comparative costs, in other words, excluding those strategic initiatives that are important to us, for us in the long term, our costs have gone up by 7.8%. In fact, 9%, sorry, 7.8 if one takes out the effect of delivery costs, which is something a little bit beyond our control. So we are not panicky about our costs. Inherently, we are squeezing the business. The issues that have led to the 16.9 are initiatives that are right for our business going forward.
Wayne, what's your plans for those retail stores you've taken on board? You said you now have 9 Spar stores, 5 top stores as well. Yep. That's the liquor outlets. Do you plan to keep those as retail outlets? Do you plan to franchise them out? What happens is that the short answer to the question is we plan to keep them. Obviously, having stores and a for sale sign outside the front is not good for business. So we plan to keep them, and we have established a retail division and put some infrastructure in place for the future. I think one understands we have 1,500 retailers when you take Spar, Tops and Build It retailers at any point in time, and you will always have some guys who get into difficulty. What we have tried to do historically is try and deal with them in isolation and bits and pieces in each of our regions, and we have decided that it's not the best solution. Rather, manage them properly and have an infrastructure in place. So we see that as something. It's certainly not a change in strategy overall. We still believe very strongly in the importance of independent retailing. However, we will run these stores properly, and it also so we've established that division primarily for defensive reasons and to protect our strategic sites. However, we will use that, if we need to, for offensive reasons. In other words, if there are opportunities there, we don't have an independent retailer, we can now go for it.
Well, in line with becoming a little bit more defensive, let's take a look at Build It and that division specifically, because one questions the kind of energy and capital you're putting into this. One would assume that with the kind of trend we've seen outlined this time round, where turnover for Build It grew by 21.4%, and that reinforcing what Massmart did yesterday in terms of showing an increasing trend within that home division market, that you would be spending a little bit more of your focus down that way.
Absolutely. I mean, we see that as a good growth opportunity for the group going forward. It has performed extremely well in difficult trading conditions. We know that market, that industry is far more cyclical than is food. So for us, we continue to spend a lot of time, effort, and focus on driving that business. At the same time, what we are not trying to do is chase store numbers, for want of a better word. We want to bring people in selectively, in other words, having thought carefully about whether they have got a long-term future in those sites, and make sure that those stores are successful into the future. So you will see we only opened probably, I think it was about 10 stores in the period. We're not out there just trying to chase numbers, but it has lots of opportunity in our country, and so it's an important focus area for us.
Wayne, what does your Capex budget look like for the next 12 months or so?
Capex-wise, we have spent probably in the region of about 1.2 billion in the last 4 years, which is a lot of money for us, in upgrading our facilities and our technologies that run those facilities to make sure our logistics are more efficient. But what had happened up to that point in time, I mean, obviously we'd had phenomenal growth in volume in particular, which is what is important to our warehouses, and we'd end up with a whole lot of satellite warehouses. So over the last 4 years, we have expanded our distribution centres, doubled the size of some, brought in new facilities, and so a lot of money has been spent. So as we look forward, that is going to be significantly reduced. We've done the work that we need to do there. The Capex going forward is probably going to be, for this year, in the region of 170 million, something like that. And next year we would foresee that it's going to be a similar sort of number.
When we've looked at the growth opportunities in South Africa, how about further afield? Are there any plans to expand further into Africa? We know lots of retailers and wholesalers, indeed, are eyeing some of the growth opportunities in Africa.
Yes. I mean, obviously, we, like everybody, we've been out and about and looking around. Obviously, we also, being a wholesaler, we're not going to go and put a 400 million rand distribution centre up and then sort of say, okay, we're the customers. We're a little different to the traditional retailers who can go and open a store or two. So, however, having said that, I mean, we've opened a couple of stores in Mozambique in the last year. We're in all our immediately surrounding, let's call it the SADC countries. We have an investment in Zimbabwe we've had for a number of years, which is really improving in leaps and bounds. But we continue to look at some additional countries a little bit further north. But yeah, for us, we will do it carefully. We're not going to rush headlong in there. As I say, we are primarily a wholesaler, so our model is probably going to have to be tweaked as we go there. But we will, the answer is, in short, we will be in some of those countries. I won't at this stage say which.